Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending Sep 4, 2020. I'm Preston Brenton. Thanks for tuning in. Remember guys, don't be a rat brain trader. You want to be the red striped zebra. Stand out from the herd. This week's theme essentially is what goes up. Well, you guys probably know the rest of the story, right? It's got to come down. So let's take a look at where the markets fared this week, and then we'll go into a little bit more detail, then we'll take a look at the chart. So the first thing let's do, let's just take a look at the world markets and just kind of see how things played itself out. If we look at it, you can see the U.S. index performance in the upper left box. You can see everything was in the red for the week. The Dow, S&P, Nasdaq, Russell all down. Nasdaq down the most for the week, 3.3%. And if you look at the year-to-date performance, the only two in the green is the S&P and Nasdaq. 6.1% for the S&P and about 26.1 for Nasdaq. And just continuing over to the right, you can see the trailing 12-month PE ratio for the S&Ps at 37.92. That'll probably go up a little bit higher as we move forward just because of the way we're dropping off 1 month and adding another month. So we're including the March fiasco, I guess. But pay attention to the forward 12-month ratio, the PE ratio, 25.64. Now it's 32% lower than the trailing, but it's still elevated, folks. Typical 20-year average is around 15, 16 for the PE ratio. But the reason why it's so high right now is for interest rates are very, very low. So you've got money really nowhere else to go, and it's willing to pay more for every dollar of earnings in the future. So that's kind of what we're seeing right now. The dividend yield, 1.77%. 10-year Treasury finished the week at 72.1 basis points. All right, so that's 72/100%. So the spread on that's about a little over 1%, 1.05%. So that still tells big money that it's more profitable to put your money in the a basket of S&P stocks rather than chasing the 10-year Treasury, although the 10-year Treasury is still very, very popular, even with the lower interest rates that we're seeing. And the current VIX finished the week up 30.75. That's 25.33% increase for the week. So we did see volatility come back in. The sector performance for the week, well, you can see in the middle of the screen on the left-hand side, you can see the best performance was materials, XLB, about 31 basis points to the upside. The worst is energy, 4.57% to the downside. And you can see year-to-date, technology still leading the way, about 29.88%, just slightly better than the overall Nasdaq year-to-date of 26.10. Energy's bringing up the rear, just getting decimated, 39.86%. And then, of course, if we go down and look at the world index performance, there's not much in the green, either weekly or especially year to date. But if you look at weekly, the only winner for the week was Japan. The Nikkei came in 1.41% to the upside. A lot of that attributable to when Shinzo Abe is stepping down because of health reasons. The leading contender came in and said they're going to keep up what he was doing, so that kind of soothed the market there. But year to date, everybody's in the green or the red. You can see the FTSE over in Great Britain still having trouble figuring out Brexit and what they're going to do. So there's a lot of unknowns there, but it's down 23.11%. And then in the green is China, 10.01. So if we were to look at some of the big markets globally, really, there's only three markets that are up year to date: the S&P and the Nasdaq for the U.S. And I might add the Dow, which was in the green year to date, the close of last week is now back in the red again. So it's kind of hovering around the center line. And then China, it's the only other one, up over 10%. So that's kind of what we're seeing as we look at the markets right now. And then, of course, if we just kind of take a look at the individual sound bites of just kind of what's going on in the market. So let's look at market volatility. I said market volatility returned this past week. We saw this Thursday and Friday. Thursday, I think we had a decline of over 3% on average. Friday, it was down 1%. So it gave us the worst weekly performance since late June of this year because everybody's just been used to the markets just blasting higher. We had 4 weeks in a row for the S&P advanced up with technology stocks pretty much leading the way to all these record highs. And then the final 2 days, we saw the erasure of over 1.7 trillion in profits, just poof, gone. So those that didn't hedge, those that didn't pick up puts, and remember last Sunday I was telling you guys, pick up some puts. We've been doing a little bit of that over the past 3 or 4 weeks. picking up some puts because we were getting a bit stretched. Now, this was just a normal evolution, so it does not surprise me that we had this pullback. I'll show you the charts here in a minute of what I'm seeing. Also, towards the end of the week, though, it didn't even help that on Friday, the Department of Labor released their data showing initial jobless claims coming in at 881,000. So that beat analyst expectations, came in under a million. We saw 1.4 million jobs added in the month of August, and we saw growth in productivity of 10.1%, and the unemployment rate came in at 8.4. They were expecting about 10.2. So beats all around on Friday. The markets initially went up. I was watching the S&P futures in pre-market when the numbers came out at 8:30. They were under by about 10 or 11 points, and then it moved up to 8 to 10 points, and then throughout the day it gave it all up. We bottomed early in the afternoon, and then we just slowly worked our way back up, but we still managed to finish the day in the red. So it's just all in all, we had a very strong down move as people decided to take profits going into the holiday weekend. And I was watching, it's kind of funny, watching the TV talking heads. Every one of them trying to find a reason why the markets move up or down every day. And I tell our members, it's just, it doesn't work that way. Okay, more on that in a minute. But that's kind of what we see with market volatility returning. Top 5 stocks. Well, again, we're looking at Apple, Microsoft, Google, Amazon, and Facebook, right? They represent roughly at the beginning of the year about 18% of the market capitalization of the S&P. And that was up from about 12% 3 years ago. So it's showing really strong growth in technology, especially these 5, right? And then just recently, it's grown from 18% at the beginning of the year to about 23, 24% of S&P's market cap. So these are continuing to grow. So naturally, when profit taking occurs in these stocks, you're going to feel the pain throughout the index, especially Nasdaq 100 and the S&P. But it's still, I suspect, leadership is going to continue there. It should be relatively strong. So, I'll show you the charts here in a minute, but that's kind of what I'm looking at. Okay. Now, I was telling you earlier about the markets and expectations and things like this, but rarely has the stock market's relationship with the economic and social and political health of the country been debated and talked over like I'm watching it today. You cannot turn on a business channel, whether it's MSNBC, Fox Business, CNBC, just any of these business channels, even Bloomberg, turn them all on, and you got a healthy debate among the analysts on what's causing the markets to do this. Everybody and their uncle is debating all the same topics, right? And when everybody wants it to happen a certain way, then it typically doesn't happen that way. That's just the way the markets work. I mean, they're all debating the extent of this market, and everyone just doesn't believe the price action that we're seeing given the results on the ground with the economic activity. I mean, common sense leads us to believe that corporate valuation should be directly linked to the economy and quality of life stuff, right? On a real-time basis. But as I continued to coach our members, and especially for those of you out there that haven't been trading very long and you're getting used to this or trying to anyway, you miss it all the time. And this is the biggest mistake I see in folks that I'm coaching. Even intermediate traders can just miss this point. And sometimes advanced traders, you kind of, you shake your head at it, but you understand it. You may not necessarily logically agree, but you understand it. And I've consistently taught our user group members, it's not always the case that the economic data is tied to the S&P price action. Okay. Ask the rhetorical question, how much do we attribute stock gains to dividends and earnings growth in comparison to, let's say, valuation expansion, multiple expansion, or even the willingness of investors to pay more for stocks, right? Or how do we account for the impact of Federal Reserve cuts in interest rates or various types of liquidity injections that the Feds have been doing from 08, 09 financial debacle to what we're doing now with COVID, and how do they tie that into corporate performance and investor sentiment? Keep in mind, the markets are like a voting machine, right? Each day they take a vote, and it can be up or down each individual day. But longer term, As Benjamin Graham once said, it's more like a weighing machine, and fundamentals will weigh in over a longer term. But in the short term, it does not work that way. And you can see sometimes the economy gets ahead of the market price action, and sometimes the price action gets ahead of the economy because the markets are always pricing in. And it's even worse now with automation. It wasn't as bad in the 90s and early 2000s, but it's worse now with algos and things firing off, just kind of telling everybody this stuff is going to end, and if it ends, this valuation should be X instead of Y. So the markets start pricing in X right away, even though there's no hint of X even around the corner. And people that jump in early tend to bring in other people early, and then other people get in early. And then that tends to promote, well, gee, if they're getting early, I'm going to get in even earlier. And that's just the human nature of trading. And then you end up creating these asset bubbles. And remember, the markets always overcorrect, not only to the upside, but to the downside. So, one of the things you've got to divorce yourself from as a beginner, junior, or even an intermediate trader is the markets are not the economy and the economy are not the markets. They will self-correct over time. And because we're up so much and our valuations and PE multiples are so high, I will tell you that statistically, when we get this high, the forward earnings growth of the S&P over the next 10 years is not as strong as it's been over the prior. So we can expect the market to slow down. And I'm not saying next week. I'm not saying next month. Lord knows we got a lot of potentially volatile actions coming up, especially the election coming up in November and all the craziness that leads up to the election here in the United States. It's going to be one of the most contentious elections out there. So, and for our members, next Sunday evening, I'll go into more detail on stocks. We'll build a stock watch list of, depending on how the outcome goes, where you want to be and what's going to be favored versus what's not going to be favored. But really, sentiment matters. Expectations matter. I mean, if you look at our earnings, they were still extremely poor, but they beat expectations for Q2. In fact, everybody was so pessimistic and the bar was so low that over 80% of companies, as we round out Q2 earnings this year or this quarter, beat expectations. The average is around a 73% beat rate. So we haven't had a beat rate like this in a long time. So everybody was overly pessimistic. Okay, both top and bottom line. So companies beat, and that's all the market expectation wants to see. If the markets beat expectations, markets go higher, right? It tends to do that kind of thing. Now, the other thing that I want to talk about, and I see it from time to time, you may or may not have heard of the Buffett Indicator, and it's right now it's flashing red. And Buffett's kind of fond of using that. And what he does is he takes the Wilshire 5,000, so it's like 5,000 stocks across the S&P or across the U.S. And it tends to include just about everything. So it's a little bit more homogeneous and it covers everything, not just tech or one sector. And he divides that by the annual GDP. And right now it's flashing red. Okay, it's at its current highest level since the internet bubble crash of 2000. The ratio reading is 1.7. That's 70% above the historical average of just 1, right? It should come in around 1. I mean, that means the total market cap of all US stocks generally comes in equal to the annual GDP number, right? So about a 1-to-1, give or take a little bit of a rounding error and things like that. But that's the general reading. Right now it's 1.7. So generally, he and other analysts and fundamentalists consider stocks fundamentally overvalued when the ratio increases to 1.3, okay, implying that the stock market cap is 30% larger than the GDP. So you can see now why it's flashing red, right? It implies that the total stock market cap is 70% larger than the current GDP, okay? And as I said just a few minutes ago, Benjamin Graham, the father of value investing, I guess that's kind of who Buffett learned from at his footsteps, right? He once said, in the short run, the market's a voting machine, but long term, it's a weighing machine. So, that kind of metaphor suggests that the short term prices are driven more by sentiment, which, as I say, that drives price action for 90% of you guys out there because you tend to be short term traders. Even if you say you're a value investor and you invest for the long term, it's hard to hold on to a stock longer term when you see it down 10 or 15%. right? So people tend to convert themselves into shorter term investors, right? So sentiment does drive price reaction shorter term, okay? And by that, I mean anywhere from 2 to 3 months out to 6 months in time, they can get ahead of themselves. Um, so that's a little bit about what we're seeing right now. It's a little bit about what I'm seeing in the markets. All right. And just keep in mind, Monday is a holiday here in the United States. So globally, the markets will be running really slow. I think there's a couple of other countries that are going to be off on Monday as well. But the big one is the US. So we're going to be off. It's going to be a nice holiday weekend for everybody. And then we're going to pick it back up with a holiday shortened week. So we'll kind of see where the markets want to go after this Thursday and Friday really big move lower. So what I'm going to do is I'm going to switch the screens. So let me just get the screens over. Let's go take a look at the charts, kind of see how things are playing themselves out. I'm going to show you, I'm going to take you to the S&P 500 E-mini futures. Okay, so I will wait for the chart to paint on the screen here for you, and then we'll just switch it over. Okay, so what you see right now is the S&P 500 E-mini futures, and you can see on here, we hit my target. Now you can see the color of this bar is longer and bigger and wider than the color of this bar. This color bar here was generated on a daily chart. This bar here was generated on a weekly chart, okay? Now we came up and we hit this. I posted this up here back in early July, and I said the target was 3,300. 32, 3,300, or about 3,310 roughly, right? Let's just take it out and move on there. And that was back when the markets were down around 28, 29. So that was a forecast that I made. And I even put it here so you guys can go back and look and see. I had a 3,300 forecast when the markets were around 2,800. And then boom, we came right up and hit it. And then we were running sideways for a long time. And then I put this weekly forecast up here, and it had a range of 3,600 to 3,700. Okay, we came right up and hit it. Typically, when you hit this, and by the way, this bar, I'm using E-Signal Advanced Git. This bar is generated by a couple of different amalgamation of indicators. One is the Fib extension off key pivot lows and highs, prior pivot lows and highs, and GAN. It does a statistical analysis of all this and puts in the best fit, and it usually comes in pretty good. Okay, and you can see here, I could put all those on my screen, but there's just too many damn lines running through, especially using GAN, but I like the theory. And it just kind of amalgamates it and puts it in as a color bar, which I think to me makes a lot of sense. So you can see we ran right up and hit it. I mean, I had forecasted the low end side of the range at 3,600. We hit 3,587, and then we pull back. Now for our members, you can see here, if I blow it up, I had called our S1 value, our first level of support, sitting right at 3357.25, and we literally came down and missed it by just a few points. All right, and that was the hit that we made. Now if I move it back and I show the months of going back to early April when the markets really were moving hard, right about right there, you can see here all of this volume over price. That tells you where a lot of activity was happening, right in that area right there. And if I were to extend it out, that also happens to be a key pivot point, right? And that's why all the volume took place, because we were in this trade box right there, that little play field. That was our field to play for over a couple of weeks. And right at the bottom, 33.57 naturally came in here. We found support and we bounced up. These were buyers. They came in and they bought way back over here, right in that area here, and they drove the markets higher. So these buyers and people that were in here were waiting to take advantage of this, and this has kind of been a algo controlled also, right around 33.50 to be exact, but I had put it in right at 33.57. Okay, now you can see these little air pockets right here. These air pockets are where it's very empty, meaning there's not a lot of buying or selling going on. And the next big one is sitting right here, just below the closing price of 2019. So if we were to come down to this next big air pocket and put us in here, that puts us right at 3,200. Okay, and that is an area that is my make or break line on just how ugly this pullback could get if we get down there. Now, I had called this our S1 value. It was our first level of support. And then I actually had a range here for S2. So this is more of an S2 zone. This is our second level right here, sitting just above these active previous buy points. Just think of these as where buyers and sellers, bulls and bears, are duking it out, and then who's going to win? Right here, the bulls won. Right here, the bulls won. I mean, it took it up, and it took a while because initially the bears won right here. We came down and we came right back up, and we just spent a lot of time here, a couple of weeks before the buyers kicked in and took it up to the next field of play right here, and then buyers took it up again, right? And you can see the volume it's just it just builds up, right? So we got a volume level here, we got a volume level here, and we got a volume level here. So you can almost like plot it on a graph. So the lower we go, the more buyers are willing to step in. So it's been a buy the dip rally since early April. So now this volume over price goes back to the beginning of April. So that takes into account really the bulk of the buying and the bullish behavior that we've seen in the market since the March 23rd lows. You can also see the MACD, for all practical purposes, is relatively flat. It did pick up here, so that does suggest that any movement down here is going to be bought. You can see we came down here and the buyers took it back up. We closed right here, but we came all the way down to this level here. So I want to see if this momentum picks up. Now, typically, for those of you that are short-term traders, you're trading weekly options, and you want to play them. What you can do is then you can run a run a Fibonacci node, right? Like this, and just run it of just that 2-day run, right? So you can see that 2-day run right here like this, and you can see the Fib node, and it almost closed right at the 50% move from Thursday to Friday, almost 50%. So you're going to want to use this. In fact, what I'd recommend you use, let's not do it this way, let's do it the other way. Let me just see if I can just get that like this. Let's try it like this. Run it this way. So let's do a Fib node extension off the bottom, right? So you can see here, let me just get that off the screen. Let me blow it up so you guys can see it just a little bit better right here. Okay. So you can see from this low point right here, and this is kind of what you may want to look at for next week, right? You can see that Fib node right there, and we closed right here. So it's just south of the 50% move back up. So if you think this area right here is your field of play, right? This box zone right here, and the 50% level. So typically when you have after the markets have been just running up really strong like that, you run up and test this zone right here. You'll come back down and do a retest of the lows that were made in this case on Friday. Okay. And then if it holds and comes back up, that's a good sign. And the bulls will tend to get longer here as it builds its way back up. Okay. If we blow through the 61.8%, then the odds favor that low is already in place. And then we may chop around a little bit while we're trying to build up momentum to take out the 2020 all-time highs of 35.87. So this is a common pattern that you guys may want to look at. Should we come back down and take that low out, then, and I'll open up the screen a little bit more, then we're going to come down to my S2 down in this L here, which is around the 3200 level. Okay, that'll take us into the red for the year, and that means that the selling is not done. Okay, the selling is not done yet. Now remember, there are a lot of weak hands in the markets. We've seen a growth of a little over 6 or 7% of retail traders. The retail trading volume in 2019 through this time of the year was about, I want to say about 12%. Now it's almost 20% of the total trading volume is retail traders. And probably the reason why are there's a lot more people working from home. They're at home. You're getting Robinhood and some of these other free commission type trading things out there. And for those of you on Interactive Brokers and Schwab and Thinkorswim, you probably noticed the trading platforms are slower because they've just got so much more. I mean, the volume has increased dramatically. It's like every day is acting like a panic day from a volume perspective because everybody's jamming through. And I know the brokerage platforms are working really hard to correct it and add bigger servers and blah, 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 but it's probably going to take a place, at least for the next couple of months as we move through the end of the year. But this is what I would watch, guys, on the charts here for the S&P 500. Now, if we come in and we look at Nasdaq and we put it on here, you can see with Nasdaq, again, we're above the 50 EMA. So what I'm going to look at on that, this is Nasdaq 100 futures. If the 50 EMA holds, that'll be a good thing, right? And you can see the 2-3% extension off that, but I've got to change this. So I've got to come in here and I've got to update the chart. So what I'm going to do is I'm going to come in here and do the correct high price of the 12,465.25. So once I put that in, it's going to lock in the correct Fibonacci retracement. So now you can see the 23% pullback is sitting right here, and also a key pivot, right? And look at the volume right there. It's amazing. And a lot of the reason why is the algos and everything are tied into these fibs, and they use them like clockwork. You can see the expansion of the 50 over the 200, and when you get an expansion like this, we've got to get this thing back in order. You can see the MACD, there's no divergences, so that means that any selling is going to be met by buying, but then the question is where, right? I've been calling for about a, let's say, a couple hundred point pullback, and anywhere from 3% to 7%, somewhere in that range. And I know it's a wide range, and if anybody tells you they know exactly, they're wrong. They don't know, they're guessing. But we look at the volume over price, we look at key pivot points, we look at Fib nodes, and then we just watch it. And that's kind of what I'm seeing right now from this perspective. Now, if we flip back to the E-minis and we come over to the Ichimoku cloud, you can see on the Ichimoku cloud right here, same thing, the highs, and you can see this green portion here, which represents the support zone of the cloud, and you can see how it's going up over time. That's suggesting that the markets are going to want to go higher, but you can see the cloud over time is sitting right around a key 3,200 level, okay? So I believe we still have some more downside left. If we go up next week, I'll be surprised. I do believe we'll probably come back and test the lows that we made on Friday, maybe run up, and be careful with bull traps in markets like this where they try to trap you in and they move lower, right? So just be careful of those. So if we were to come in and look at some of the big stocks, let me just switch you over on the screen here, and let's take you over and look at some of the big ones. I'll start with Amazon first, because that's just huge, and they just came down big time. Where the hell? Oh, I know why. Hang on one second, guys. I got to get this right like this. I got to move the screen around a little bit so that you guys can see it. I got 12 monitors on my desk. It's like trying to drive with a rear view mirror. Okay, here we go. Let's come to this one right here. So this is the Amazon chart on the daily. I'm going to let it paint the screen for you, and you can see very clearly when it comes up on the screen here. Look at how, and let's just blow it up so you can see it. If you look at the 50 EMA, look at how Amazon came down, bounced right hard off the 50 EMA, right? This is Amazon. It was down 73 points today. It was down big time on Thursday, and it started by gapping higher. It actually gapped up, but it had an ugly candle on Wednesday, and that was kind of just telling you, hey guys, something ugly is coming. Now, if we zoom out on this, you can see here we have what we call a poor man bearish divergence. Ideally, I like to see 3 crosses in the MACD. Here we got multiple crosses, but it's still a divergence nonetheless. That does suggest we can come back down and test this area down here, possibly move down to the 3,000. I don't think we're done yet, but let's just watch it and see. Now, if we look at Apple, it had a better day on Friday. It actually closed up a little bit. Let me get that off the screen, and let's get it back up again. So if you look at Apple, again, look at the 50 EMA. Notice right here how it tested the 50 EMA, and it tested it right here as well. There is no bearish divergence here. That does suggest that any move lower is going to be bought by buyers, and the question is, where are they going to step in? The last time Apple was below the 50 EMA was back in April, and this was as we were coming out of that March 23rd crash, right? And that's the only thing that moved Apple below its 50 EMA was the crash. All right, and it started moving below right at the end of February. And then boom, we've been above ever since. And any test of the 50 EMA has been met by buyers. And that's also an algo thing. So you can see when it got down here, buyers were willing to step in and pick it up. All right. So we're going to watch these guys very closely. Let's take a look at Microsoft. And by the way, Apple no longer has the weighting in the Dow that it had before. Look at Microsoft. It's just use the 50 EMA as a guide mark, right? And not counting the March 23rd lows. You can do it for all the top tech companies. You can see here with the 50 EMA, we tested it. We tested it here. We tested it here. We went below, but it's where you close during the day, right? You can see this close right here. You can see the divergence right here. There is no divergence in Microsoft, so that does suggest that any selling is going to be met by buying, any dip, buy the dip kind of mentality. So we're still into that kind of mode. Okay. So those are just some of them. If we take a look at Google, let's look and see what Google's doing right here with Google. Now, so if we look at Google, you can see right here that Google also, now Google, look how it rode the 50 EMA right here. I mean, almost every day for over a week. We did go below briefly right here in June, but most algos pick this up, and you can see, okay, is it finding support at the 50 EMA? Yes. Then when it touches the 50 EMA, buy. So if I blow it up, you can see here clearly the algos are in charge here. They're watching this. And buyers are coming in, and it's a technical thing. They're seeing this, and they're going to buy. Right here, it comes down, it kisses the 50 EMA, we buy, right? And if we look at it, there is no divergence right here in the MACD. That does suggest any selling is going to be buy the dip kind of mentality. So what's a dip? Traditionally, a dip is down to the 50 EMA. We come down there, buying kicks in. So what we've got to see is be very careful on a bull trap, right? That means it goes up, you think you're bullish, you jump in, and it rolls back over. So as I said, run a Fib node from Thursday and from the red candles, and you want to see it move above the 61.8% extension off the lows. If it does that, then that generally means the low is in near term, and we're going to run higher. If it doesn't hit that 61.8, then the odds dramatically favor a rollback over to touch the lows again. So it's just something you want to do. And again, these are probabilistic moves. They're not certainties, but they get you 65, 70% edge roughly on some of these short-term swing moves. Okay, so that's a little bit about that one. And then the last one here is Facebook. These are the big guys. If we take a look at Facebook, again, look at the 50 EMA here. We briefly broached it, but only for one day. Notice it was down there, but then algos came right back in. Here it came close to the 200. But look right here, the 50 EMA, it's confirming for a lot of bulls that are watching it. Should I buy? Should I buy? And then boom, it gaps up, they buy. And then right here, we're well north of the 50 EMA. Right? There is no divergence on the MACD. So again, all of these are showing buy the dip, so then the next question is, well, where's the dip end? Okay. And that is a little bit of a speculation on this, but use the Fib node extensions off these 3-day run, and that'll really help you out dramatically. Now, if we look at the VIX, if we come in, I'll show you the VIX here, but I want to show you the skew, which is probably more important than the VIX, is this term structure. Notice here with the VIX, we actually moved up to 38 on Friday when the markets were at its worst, 38 all the way up here, and then it closed back from the red at the high end here. As I said, 30.75. So the VIX was dramatically elevated, right? And I showed you the charts where the falling wedge in volatility signify that the odds favor a move higher. Okay. And this is when I was telling our members we got to pick up puts. I mean, that's kind of what you want to be doing. Or there's some other things that we use to trade these things. All right. So that's a little bit about what I'm looking at the VIX. But let's look at the front month skew. So the front month skew is just a measure of the current VIX versus the front month vol futures in September. And notice we're in the red, okay, to about the tune of 90 basis points. That means we're in a backwardation in the term structure. That means there's fear on the front end of the market. And fear starts on the front end and goes further out in time. So you can have a front month backwardation and then a contango market or a normalized skew further out in time, because fear tends to show itself near term, not out in time. So we're looking at the front month skew. You can see it's in the red, 91 basis points. So 0 is the break even. So we're in the skew. Now, if we look at the back month, that's both September and October, you can see we're well into the green. So this is just a short-term fear thing. Vol up a little bit. People are now rushing to buy puts. The fear hasn't really extended itself out further in time. So that's why I still believe we're in a buy the dip, but I think the dip can go a little bit deeper. If it doesn't, then that just means there are more buyers willing to take this even higher before we get a larger dip. Okay. So that's a little bit of what I'm seeing here. If we look at the bond market fell hard. All right. Remember, we were in this range here for quite some time. This range here, and we were trading the range. When it got bottom of the range or to the top of the range, we're just playing it to stay inside. And now, as I said, I favor the range to come down and interest rates to slide up a little bit, because you're going to see interest rates moving to the top of its range. And if we look at the 10-year rate, you can see here the 10-year rate. It's in this range here. But, you know, there are ways to trade this. You would trade TBT if you want to trade the direction of interest rates, or TLT if you want to trade the direction of bonds. You're trading the same thing. You're just using a different asset class to express your opinion. All right, one runs the opposite of the other. So interest rates, I think, or at least the way the markets are concerned right now, we're going to stay low for the next 2 or 3 years. That's what's priced into the markets. The Feds have come out and said they've changed the way they're going to run it. I did a little spiel on that last weekly roundup last weekend, where they're going to use an average inflation rate instead of a target rate. That means they're going to let inflation run higher and hotter than normal. But I promise you, the bond market's not going to let that happen. The bond market, the minute we get over 2%, of the engage that the Feds use, the bond market's going to start anticipating it. It's going to start coming down hard, and you're going to see interest rates going up. And that's going to put more pressure on the equity markets. And members, we'll go into some other sessions on how to kind of just foretell that and play either the yield curve or play interest rates if you want to, or play some of the interest rate sensitive equities that can play that. A lot to be told on the currency market. If we look at the dollar, if we look at the dollar index, you can see that again, every move higher, it's a sell the rally in the US dollar. I still believe that. You can see every rally that we've had, boom, we just roll over. It's like a rolling wave. And you know, you could come in here and you could just slap, you could see the channel, probably most of you can see the channel. So if I put the channel on it, there it is right there. So we're at the top. So and this is a big R1 zone or resistance zone. So if we get up in this area here, I would expect the dollar to roll back over and possibly make new 2020 lows, okay? Now, if it doesn't do that and it breaks out of this price here, then we got open field running. And notice there's the 50 EMA right there on it, and the 200 EMA is way up here. So I just think the dollar is more prone. There's just so many shorts in the dollar with all this money printing here in the U.S. and all this stimulus that it's just going to be hard for the dollar to really get anything going. But you know, anything can happen. I mean, you got to play what you see price action versus what you think, or no matter how logical or illogical the move seems. Right now, sell the rally. That's what we're looking at in the dollar. And obviously, we're going to buy the dip in the euro. This is what I've been telling you guys. Here is the euro. You can see it's just the opposite. And here is the support zone, the S1 zone, sitting right around the 50 EMA right here. Okay. The euro was actually up to $1.20. The ECB, one of the members of the ECB came out and said it was starting to get a little bit high, and then the markets just sold off. Because you're going to see the ECB, they do this even better than the Feds. Rather than adjusting their rates, they just come out and say they're thinking about doing something like raising the rates, or the euro's getting a little bit strong, and then the euro just magically sells off in anticipation of them doing something. So this is where they really listen to it, and they use their mouthpiece very well. They use the podium very well. If we look at gold, gold is doing kind of what I said it was going to do. Right here is the you can see the trend line of gold right here. We've had multiple touches. All you need are 2 touches to define a trend zone or trend, upsloping or downsloping trend. And now if we look at it here, you can see it hit it right here, and now it's hitting it. It's sitting right on that trend. Okay. If it breaks and moves lower, then this area right here, we're going to come back down and test the 50 EMA. Gold is a very technical trade. It trades the technicals better than most others, and so you see a lot of people that are heavily in the gold market are using it to trade the technicals. I have a forecast in here of gold hitting 2135. Okay, this could be a long, complex Elliott wave 4 because they tend to be very complex. They're waves within waves. But if we take out this low here, that could mean the 4 wave hasn't been settled yet, and it's going to go lower. I've told people that we've been long silver over gold. Gold is a good long play, but silver was a better one on a return on capital basis. So we've been playing the silver market instead. But gold, I've been telling folks, just let it rest for a bit. We need to take out this prior pivot high before I'm even interested in gold. Let's look at oil. Oil has been interesting. It got clobbered in the middle of the week, and we took out its 50 EMA. And if I back out, you can see how oil has been fairly steady, just a slow grind up, easy to trade, easy market. And then in the last 3 days of last week, it moved from 42 down to 39. Now that's still not a big move in gold, not like we used to see back over here when it was moving $2 or $3 a day. It was really wild. So even with these moves here, it's still fairly quiet. You can see the 200 EMA, this yellow line, it couldn't hold it, and now it broke the 50. So it may come down and find support in this big major support zone. It's a bigger bar, so it was done off the weekly chart, right around the 36.75, 36 area. So we could see a little bit of support in that area there. Nat Gas had one of his best months ever in the month of August. You can see here how Nat Gas has just been moving up. We were trading in this tight zone right here, right? And you can see in this zone here, every time we got down low, I was doing bull put spreads and suggesting to our members bull put spreads. Then when we got up here, we just sat down and waited for it to come back down again rather than bear call. Because here's an example of not doing a bear call, thinking it was going to come down, and then boom, away it went. What I'm expecting on Nat Gas here, there's still an overabundance of supply fundamentally. But remember, sentiment takes over and fundamentals don't matter short term. I believe it's going to come down and come back up, make a higher high, give us a bearish divergence, and on that higher high is when I'd be willing to do a bear call spread. Okay, so that's a little bit about a real quick and dirty for our holiday weekend. Members, we will have Sunday evening off. We will pick it up in our chat room Tuesday morning. If you're not a member of our group, I highly encourage you to come on in and run with us. We're having a great year, even with March thrown in. We had a great year last year, even better the prior year. So we're having a good time. If you're not a member, come on in because we trade everything. From the currencies to commodities, and you need to learn how to play these things. You need to learn how to look at volatility and all the various ways to do it. We use Toss as our platform, so in my secret trader, I use Toss. I post trades out there and what I do, so you could copy paste if you want. Follow along from an educational perspective, of course, but you can see what we're doing, and I trade what I say, right? I'm not just a paper trader and you follow paper trade, so it doesn't matter. I take a stake in the hunt. And I'm out there in the field with boots and a gun as well as everybody else. So guys, I will see you guys on Tuesday. Have a great holiday weekend for those of you that do celebrate. If not, then it's going to be a quiet Monday. Take care, everybody. Ciao.